Donald Trump didn't just brag about a strong economy. He helped build a bonfire of garbage debt, then locked the exits and called it the greatest boom in history. Friends, this is Richard D. Wolff. Thank you for being here. You've heard the line 1,000 times. Strong and resilient. Best economy ever. Trump repeated it like a slogan. His allies still do. Cable news graphics, flash green arrows, unemployment charts, record profits, tech stocks rocketing to the sky. But what if that whole miracle sits on a foundation of trash credit and fake safety? What if the real crisis isn't just a recession, but the moment the system admits that a big chunk of what we call wealth isn't money, isn't capital, isn't value, it's just dressed up junk? That's the twist. Almost no one on Trump TV will tell you this doesn't look like a normal downturn. It looks like the early stages of a monetary breakdown where the collateral itself rots from the inside. Picture this: a drone shot over lower Manhattan at night, towers glowing gold, trading floors lit up like casinos. Below that glitter, in the concrete basement of the system, you see it: cracks in the walls, pipes leaking, cockroaches running over, stacks of unsecured IOUs stamped investment grade. Even the bankers have started saying the quiet part out loud. The so-called cockroach theory is back. You see one, there are hundreds in the walls. On Wall Street today, the cockroaches are bad loans, bad collateral, bad bets that were sold as safe income to anyone desperate for yield. For years, under Trump and long before him, the political class told the same fairy tale: deregulate, cut taxes for the wealthy, let Wall Street innovate, private equity, private credit, shadow banks. They were the new heroes, the efficient allocators of capital. Trump took that logic, wrapped it in a red hat, and blasted it through every rally. The result? A shadow credit machine that now controls at least $1.7 trillion in loans outside the traditional banking system. Loans that don't face the same scrutiny. Loans that can be marked at whatever price the manager needs to keep the illusion of safety alive. We know this isn't paranoia. The Federal Reserve itself quietly moved roughly $250 billion of risk off the clear regulated balance sheets and into the shadows, relabeling it as lending to non-depository institutions. In plain English, Wall Street middlemen got the loans. They turned around and relent the same money to the same borrowers, but now through a darker, less accountable channel. It's accounting magic worthy of a Trump real estate brochure. The building looks solid in the photos. You just don't see the unpaid contractors and cracked foundations behind the camera. And here is the deeper contradiction Trump never understood or pretended not to. You cannot flood the system with cheap money, gut regulation, cheer on every speculative bubble, and then act shocked when the debt quality collapses. You cannot tell Americans the economy has never been stronger while the backbone of that economy is being loaded with loans that only work if rates stay low forever, growth never slows, and nobody ever asks what's really on the books. The headlines still talk about a soft landing, but under the impressive language, the story has changed. The people who control trillions are no longer debating how fast we'll grow. They're asking a different, darker question: how much of this balance sheet is real and how much is garbage we've all agreed not to look at too closely? Because once a system decides to look away from the truth, it doesn't erase the risk, it just buries it layer by layer in the foundations of the economy until one day the weight of the lie becomes heavier than the building it was meant to support. Once you admit the foundation is cracked, you have to ask a harder question: who poured the concrete? Who signed the permits? And who kept telling you the building was perfect, beautiful, tremendous? Trump didn't design the global financial system, but he absolutely doubled down on its worst instincts. He cheered every cheap credit boom. He mocked regulators as job killers. He glorified stock prices as proof of national greatness. And now the bill for that delusion is showing up in the ugliest place possible: the plumbing of money itself. Look at where the garbage is piling up, not just in old fashioned bank loans, but in the shadow banking system, the private credit funds, non bank lenders, and opaque vehicles that politicians like Trump praise as cutting red tape and liberating capital. This is where the stupid loans live. This is where the cockroaches breed. These funds lent aggressively to companies sliding towards subprime status. They lent to over-leveraged buyouts. They lent into real estate that only made sense at zero interest rates. They lent into speculative tech and AI infrastructure that has yet to prove it can pay for itself, and they booked all of it at fantasy values. Here's the catch: unlike public bonds that get repriced every day, these private loans are marked to model translation. The manager guesses the value. If admitting reality means taking a huge loss and triggering redemptions, the model will find a way to say everything is fine until investors want out. That's when the trap springs shut. You can see it in real time in cases like retail oriented private credit funds that suddenly freeze redemptions and merge into bigger publicly traded vehicles that trade at a 15-20% discount to their supposed asset value. Overnight, people who thought they had a safe income product discover they're locked into a structure that quietly shaved a fifth off their savings. This is not an accident. It's a business model built on the same mentality Trump used in Atlantic City: promise the upside, socialize the downside, and when the structure collapses, blame market forces or the Fed. And hovering over all of this is the AI mania. The same politicians and CEOs who told you coal jobs would magically come back under Trump now tell you AI will rescue growth, productivity, wages, everything. Meanwhile, corporations are borrowing hundreds of billions to build data centers, hyperscale campuses, and chip capacity on the assumption that revenue will explode later. If that AI boom turns out to be more hype than substance, those loans don't just dent a few tech stock charts, they blow holes in the balance sheets of the very shadow lenders that financed the boom. The same funds already holding risky corporate debt suddenly discover their shiny future of technology, that assets are just another line of garbage collateral that doesn't cash flow. And here is the brutal twist most people haven't been told. This isn't just a game between billionaire hedge funds. It's your pension, your teacher's retirement fund, your local firefighter's savings. Because in a decade of ultra low rates, a period Trump called historic prosperity, the institutions responsible for ordinary people's future were pushed out on the risk curve. Safe government bonds yielded next to nothing. To hit their targets, they were sold a story. Private credit is safe, diversified, uncorrelated, and institutional grade. So they bought it. In size, now imagine a wide shot of a Midwestern town hall, fluorescent lights, folding chairs, a projector screen showing a polite consultant explaining why the pension fund is underperforming and needs adjustment. On the faces in that room, retired nurses, city workers, bus drivers. You are looking at the true counterparties to Wall Street's garbage lending. They were never told they were backing an experiment in shadow banking and AI speculation. They were told they were buying stability. This is the real legacy of Trump's fake prosperity narrative, a political culture that worships markets, deregulation, and debt fueled asset prices so completely that nobody stops to ask what happens when the collateral underneath all that strength turns out to be worth far less than advertised. A strong economy can survive a bad president. A rotten money system built on mispriced risk and sealed exits eventually stops being an economy at all and starts looking like a controlled demolition in slow motion. Once you accept that this is not just a story about bad loans, you arrive at the most dangerous question of all. What happens when the money system itself stops working the way people think it does? A normal credit crisis is ugly. Banks take losses, lending slows. You get a recession, maybe a bailout, maybe a political shakeup. We've seen that movie. What's forming now is something nastier, the outline of a monetary crisis. That's when the collateral that holds the system together stops being trusted. When the very stuff banks and shadow banks use as money like assets is revealed to be garbage. You can already see the stress in the repo market, the overnight lending engine at the heart of global finance. Big banks are quietly begging the Federal Reserve for more reserves, not because there's no cash in aggregate, but because nobody trusts the collateral they're being handed. Traders won't say it on TV, but the fear is simple. If too much of this paper turns out to be junk, the whole chain of lending freezes. Trump's ideology, deregulate, inflate assets, worship the stock market, ticker fed this beast for years. His version of America First never meant protecting workers from financial predation. It meant protecting financiers from accountability. As long as the Dow was up, nothing else mattered. Behind the scenes, the system was being wired for exactly this kind of breakdown. And here's the trap. The political class still thinks the Federal Reserve can save them. Cut rates, print reserves, run the old script. But rate cuts don't turn bad collateral into good collateral. The Fed can manufacture liquidity. It cannot manufacture trust. To truly bail out this mess, the central bank would have to do what Wall Street quietly wants: swap toxic private credit and overhyped tech debt for clean reserves on a massive scale. Socialize the losses of the $1.7 trillion shadow system, but doing that in an economy already poisoned by years of inflation pressure risks igniting the very outcome Trump voters were told to fear most: a currency that buys less and less while their wages stagnate. So the choice becomes obscene. Let the shadow banking structure implode and watch pensions, insurance funds, and regional finance systems absorb the hit. or monetize the garbage and erode the purchasing power of the entire working class to protect the asset values of the elite. That is the logical endpoint of Trump era economic fantasy. A country trapped between deflationary collapse and inflationary rescue because it refused to confront the simple reality that not all wealth on a spreadsheet is real. Meanwhile, the real economy, wages, job security, public services, sits on what I call the flat soda equilibrium. No fizz, no real growth, just sticky prices and rising debt. In that environment, bad loans never grow out of their problems. They just sit there rotting until someone is forced to recognize the loss. You can already see the early admissions. Bond kings telling investors to hold 20% cash, billion-dollar funds freezing withdrawals. AI darlings swinging wildly in value, quiet reclassifications of hundreds of billions in loans into the dark added up. And you do not get the greatest economy in history. You get a time bomb. Imagine a trading floor when the screens all flip from green to red in the same instant, phones ringing, no bids, collateral rejected, margin calls cascading. Somewhere far away from that chaos, a retired teacher opens a letter about her pension adjustment, a polite word for the fact that her future was used as fuel in a game she never agreed to play. That, not the slogans at a Trump rally, is the true picture of this system, a glittering casino stacked on top of a collapsing basement where the lights always stay bright right up until the moment the floor gives way.